It happened just minutes after the opening bell in Seoul. The selling came in so fast and so hard that the stock exchange did something it almost never has to do. It hit the brakes. Trading frozen. 20 full minutes of forced silence while an entire market stood there and caught its breath. And when the dust settled, South Korea's main stock index had dropped more than 9%. In a single morning. That is not a bad day. That is the kind of move that makes people who have watched markets for 30 years sit up straight in their chairs. Now, your first instinct might be to shrug. Korea. That is the other side of the world. What does a market in Seoul have to do with you, sitting wherever you are, maybe with a little money in an index fund, maybe holding a few tech stocks you bought because everyone said you should? Stick with me for the next few minutes because the answer is a lot more than you would think. What happened in Korea overnight is basically a stress test. A warning light blinking on the dashboard of the one trade that has been quietly carrying the entire stock market for the last couple of years. And once you see what that warning light is actually pointing at, you will look at your own portfolio a little differently. So let us walk through it. The Korean market is not like most others. It is unusually dependent on two companies, Samsung, which you have definitely heard of, and another one called SK Hynix, which you probably have not. And these two are not just any companies. They make memory chips. The specific, specialized kind of memory that the world's most advanced artificial intelligence systems cannot run without. Here is the part most people never connect. When you hear about the big famous chip company powering the artificial intelligence boom, the one whose name is everywhere, that company does not actually make everything itself. The brain of an artificial intelligence machine needs a very particular type of high-speed memory stacked right next to it. And a huge share of that memory comes from exactly these Korean firms. SK Hynix is so central to this that just on Monday, it briefly became the single most valuable company in all of South Korea. So think about what that means. A massive chunk of the entire global artificial intelligence dream runs straight through a handful of factories in one country. When those companies are flying, the whole market feels invincible. And when they stumble, the floor starts to shake everywhere. On Tuesday morning, the floor shook. Samsung and SK Hynix both dropped more than 4%, and they dragged the rest of the market down with them, hard enough to trigger that emergency halt. But here is what makes this more than just a Korea story. This did not start in Korea. Rewind one day. Back in the United States, on Monday, semiconductor stocks had already taken a beating. Almost every major chip name finished in the red. There was really only one big exception that managed to climb. And that nervousness, that first crack, traveled overnight, the way these things do now, jumping across oceans and time zones, until it landed in Asia and detonated. Then it bounced right back. By the time American and European traders were waking up, the fear had come full circle. Chip stocks in the United States were sliding again. One big storage chip maker fell more than 8%. A major mobile chip company dropped close to 7%. Over in Europe, technology shares were among the worst performers of the day. This is what people mean when they talk about contagion. It is not one market having a bad day in isolation. It is the same anxiety ricocheting around the planet, getting a little louder each time it lands. And the anxiety has a name. The fear is that the artificial intelligence trade has gotten, in the polite language of analysts, overstretched. In plain English, too many people betting too much money on the same small group of stocks all at once. Let me make this concrete, because this is the whole point. For the last couple of years, the stock market has gone up. A lot. But if you actually look under the hood, most of that climb has not come from thousands of companies all doing well. It has come from a tiny cluster of names tied to artificial intelligence and the chips that power it. They got so big and so dominant that they basically became the market. When they win, the indexes hit record highs and everybody feels rich. When they sneeze, everybody catches the cold. That is a beautiful thing on the way up. It is a genuinely dangerous thing on the way down. Because if everyone is crowded onto the same side of the boat, the moment a few people decide to move, the whole thing tips. If you are getting value out of this, do me a favor and tap subscribe. It genuinely helps the channel more than you know. Okay, so a fair question at this point is, why now? Why did the nerves suddenly snap this week and not last month? A few things have been building up quietly in the background. For one, there are growing whispers that the world might actually be building too much of this stuff. There are early signs of a glut, a kind of oversupply, in the very chips everyone assumed would stay scarce and precious forever. When something everyone fought over starts piling up unused in warehouses, the price tends to fall, and the companies making it suddenly look a lot less golden. On top of that, investors have started doing something they forgot to do during the euphoria: math. They are looking at the staggering sums these companies are pouring into artificial intelligence, the data centers, the chips, the power, and they are asking a simple, deadly question. When, exactly, does all this spending turn into actual profit? And what if the answer is later than everyone hoped? There is also a very specific event hanging over this week. One of the big American memory chip companies is about to report its latest results. That report is going to be read like tea leaves. If it is strong, it could calm everyone down and this whole scare gets remembered as a blip. If it is weak, or if the company sounds even a little cautious about the future, it could pour gasoline on exactly the fear we just watched torch the Korean market. So everyone is holding their breath. Now, here is the part I really want you to take away, because it is bigger than any single week of headlines. What you are watching is a lesson about concentration, about what happens when one idea gets so popular that it swallows everything around it. The artificial intelligence story might be completely real. The technology might genuinely change the world. I am not here to tell you it is fake. But a great story and a safe investment are not the same thing, and the gap between them is exactly where people get hurt. When a trade gets this crowded, two things become true at the same time. It can keep going up far longer than seems reasonable, and it can fall further and faster than anyone is prepared for, because when the selling starts, everyone is trying to squeeze out the same narrow exit at once. That is precisely what a 9% crash and a trading halt look like. It is the exit getting jammed. And there was one more quiet detail in the wreckage that tells you what the smart money was thinking. While the chip stocks and the flashy technology names were getting hammered, money did not just vanish. A chunk of it rotated. It moved into the boring, sleepy corners of the market. Healthcare, food and drink, the kind of companies that sell things people buy no matter what the economy does. When investors start quietly shuffling money out of the exciting stuff and into the dull, dependable stuff, that is not random. That is a mood. That is fear wearing a calm face. So where does that leave you? I am not going to tell you what to do with your money, because I do not know your situation and I am not in the business of giving you orders. But I will give you a way to think about it. Go and look at what you actually own. If you have got a simple index fund, understand that a big slice of it is probably riding on this exact handful of chip and artificial intelligence names, whether you chose that or not. You may be far more concentrated in one single bet than you ever realized. That is not automatically bad. But it is something you should know about yourself rather than find out the hard way on a morning like the one Seoul just had. And the next time the market is screaming higher and every headline is telling you that some trades simply cannot lose, remember the 20-minute halt. Remember that the most crowded trades always feel the safest right up until the second they do not. This particular scare might fade by next week. The chip companies might bounce, the earnings might land fine, and everyone might forget this ever happened. That is genuinely possible. But the deeper truth it exposed is not going anywhere. A market that leans this hard on so few companies is a market with very little room for error. So watch the chips, watch that earnings report, and watch how quickly fear can travel from a trading floor in Seoul all the way to the value of the account you check on your phone. Because in a market this connected and this concentrated, there really is no such thing as the other side of the world anymore.